Futures are down as we await the House on the big, beautiful bill. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now. Bye.
Coming up, President Trump's tax bill faces Republican resistance in the House with a vote scheduled for today. And we have a major setback for Apple as well. Foxconn tells hundreds of Chinese workers to return home from its iPhone factories in India. Plus, bank stocks keep ripping higher as Wall Street's largest lenders unleash big payouts. They're up 36%, Katie, from the lows in April.
Yeah, absolutely. Really leading that rebound. Today, you can see there's more green on the screen, less so. But this is in path to record highs, which we've seen this week. That's after the big banks passed the Fed stress test last week. And now you have JP Morgan, Goldman, and Bank of America, just some of the firms that are boosting their dividends for investors. Broadly expected, but more good news for these big banks, even though Bank of America not quite cooperating this morning.
Not today, but it's done well since the lows. We await Tesla's quarterly sales. Analysts estimating just under 390,000 cars sold. The shares during the period rose 23%. You can see they're actually up in the pre-market, Katie.
Well, Matt, you mentioned that we're waiting for the House, and to that point, President Trump's big, beautiful tax bill is headed to the House today. A little bit of a power outage there, but that is one day after it squeaked through the Senate. Now, the bill's passage is not certain, with some Republicans threatening to sink it. The president, however, not worried.
Well, I just heard that about the Senate, and the bill just passed, and it tells you there's something for everyone. I mean, it's a great bill. There is something for everyone. And I think it's going to go very nicely in the House. Actually, I think it will be easier in the House than it was in the Senate.
Joining us now is Bloomberg's Washington correspondent, Tyler Kendall. So, Tyler, what are the chances this passes today so it can be on President Trump's desk by the 4th of July? Will we have to go through an all-nighter again?
Yeah. Hey, Matt. Well, it by no means is a done deal, but we could actually get an indication on the timeline shortly because the House is about to gavel in as we're speaking at 9 a.m. Eastern. And to give you a sense of sort of how this is going to play out, lawmakers are about to vote on something known as the rule. And now this is just a procedural matter. This doesn't mean that it is a vote on the finalized passage. But why it is important is because if the rule fails, that spells big trouble for Republicans as well as House Speaker Mike Johnson. So we have to keep in mind here that there's still, when it comes to the divisions, ultimately we're seeing the same sort of factions play out that we saw in the Senate. There is broad agreement when it comes to the tax cuts in this plan, but not necessarily the spending cuts. And that's where this really could face some opposition. You have those House Freedom Caucus members upset that the Senate didn't make good on what they say were promises for additional cuts. But then I would also point you, Matt and Katie, to some of these more moderate members in the House that are concerned about the changes to Medicaid. Not necessarily the tightening of the work requirements, but lowering the Medicaid provider tax, which could mean less federal matching funds for those states that did expand coverage under the Affordable Care Act.
Absolutely. Big news there for the insurers. But let's talk a little bit about renewables, because you're seeing a lot of movement in those stocks after that solar and wind excise tax was stripped from the Senate version. Do we think that's going to survive in the House?
So that is perhaps one of the biggest sticking points here for some of those members of the House Freedom Caucus who are also unhappy about an additional agreement that was struck in the Senate plan that actually makes the phase out of some of these clean energy tax credits when it comes to wind and solar a little more lenient. How the Senate plan is currently written, it would allow developers that begin their project within 1 month of this bill going into law to be eligible for those tax credits, instead of how the House version had written it so that their project would have had been done, completed, and in service by 2027. This could be a place where we could see some sort of compromise, but also at the moment, this bill is not designed to be tweaked. It's not supposed to ping pong between the House and Senate. If they wanted to make a tangible change like this, that would take more time and it would really threaten that July 4th timeline.
All right, Tyler, great reporting as always. We'll be checking in with you throughout the day. That is Bloomberg's Tyler Kendall. And at this time tomorrow, we'll be speaking with the chair of the White House's Council of Economic Advisors, Stephen Miran, following that June jobs report. But let's get to some breaking news here coming from Tesla, which just released its quarterly sales data, which came in below estimates at 384,000. You can see that the shares are jumping, though. It wasn't a huge miss. The estimate had been for a hair over 389,000. Let's break down this data with Bloomberg Tech co-host Ed Ludlow. Tesla shares up 7%.
Right.
Can we call this better than feared?
It's difficult to say, right? You can either look at it and say that the number for the second quarter on the delivery side in particular, 384,122, even though it's a miss against consensus, were those consensus estimates stale? And is the number, the actual number, better than the lowest projections? You know, we knew it would be a tough period. Elon Musk had talked about this blowback in the April earnings call, right, due to his affiliation with the administration, particularly impacting markets like Europe. But at the end of the day, 384,122 vehicles is a lot of EVs. Production numbers seem strong. They don't seem to have any production interruption. The issue is, and it always is the case, sometimes they break from this habit. The press release that gives us the numbers has no commentary in it. There's no sort of detail on the why in this picture. But clearly the market likes it. Maybe as I'm talking to you, I'm thinking about it. Maybe the estimates were a bit stale.
It is certainly a lot of EVs when you compare it, for example, Ed, to Ford's EV sales in the second quarter. They sold, I think, just over 16,000. But it certainly isn't, and I make this point often, but it certainly isn't a lot of EVs for a trillion-dollar company. In fact, if you add up every single car company in the world, all of them, they don't reach even close to Tesla's market cap. So,
right.
How much does this really matter if you're really buying the stock for humanoid robots and, you know, self-driving taxis?
Two things. The first, did you see the data out of China overnight from the Chinese Passenger Car Association? So for the first time this year, deliveries from the Shanghai plant grew, albeit less than 1%. But there is a sort of signal change in that market. You're exactly right that the thesis of many long-term Tesla bulls is actually this bread and butter business doesn't matter. If you believe in the future that vehicles will drive themselves, they will be autonomous in the form of a proprietary robo-taxi ride-hailing service, what does it matter in the sort of marginal beat or miss in the near term on Tesla delivering cars to consumers? But at the end of the day, there is also a large portion of the global investor base that says, well, we just track you based on your fundamentals in the here and now, and you need to generate revenue and cash flow operationally from selling vehicles. So it's kind of like, depends on how long-term your thesis is and what you picture Tesla as. But increasingly, right, and this is when earnings will come back into play, the software component in the more near-term, full self-driving as a supervised driver assistance tool, and then the rollout and growth of the robotaxi service will come more into play. Still, they got to make money somehow.
Right. Well, the shares are up now 6% on a global run rate of just 1.5 million cars sold. So it's far fewer than any Tesla bull would have hoped if you'd asked last year or the year before or the year before. In any case, and I'm sure you're going to continue to cover this hard on your program. Ed Ludlow is, of course, the co-host of Bloomberg Tech. His show kicks off at 11 a.m. Eastern, and this will be one of the stories they are leaning into. One of the stories we're leaning into is the Wall Street banks, the biggest of them boosting their dividends after easily passing the Fed's stress tests. Banks have been on a winning streak lately, outpacing the S&P over the past 2 weeks, trading near all-time highs. The third best group financials are in the S&P. The KBX, as I was telling Katie, up 36% since its lows in April. Catherine Doherty is here, finance reporter who covers this stuff. So they've been on a tear.
They have, yes. And the results from yesterday, these announcements about the dividend payments, this is just going to potentially continue that tear, at least for the foreseeable future. You never know. We have earnings coming up in a week or so, and that's going to be another indication of how the rest of the year shapes out. But so far, these hikes that they announced yesterday, they beat expectations across the board. Everyone was expecting dividend payments to come out regardless, but it's just how much are they paying out. Goldman with a 33% jump compared to last year. They went from $3 to $4. I think that is what I'm seeing from a lot of analyst notes highlighted today. Wells Fargo behind them, they're up 13%. And then you have really across the board, all the banks speaking very positively about their capital. And this is in light of the new Fed stress test that we're going to see. We're going to get more detail as the year goes on in terms of how they're changing the calculation. But overall, the expectation is that calculation is going to be lighter for the banks, and it's going to give them the ability to not just raise their dividend payments, but announce more share buyback programs.
Right. We
had JP Morgan, Morgan Stanley. Those were the two banks that they gave sparse detail, but they did announce buybacks. All the other banks, we didn't see the same level of detail or announcements, but across the board, I'm expecting that the market is going to be digesting this in a very positive manner today.
Right, and you make a good point that this is the typical cadence, okay? The big banks, they pass the stress test, then they raise dividends, but we certainly beat expectations when it comes to the magnitude of those increases. You mentioned that earnings kicks off in a couple weeks' time. Just quickly walk us through the expectations here, because there's a lot of positive momentum around these financials right now.
So we had Jefferies report last week. They kind of are they set the tone for the industry, and everyone is looking for two things. Both, is investment banking coming back? Are we seeing deals, at least the momentum or the talk of deals, is it going to pick up for the rest of the year, or has the uncertainty kept companies on the sidelines? So Jefferies kind of gave some indications that no, they're not seeing their results necessarily beat expectations. However, they have left a pretty positive note for the rest of the year, just based on conversations that they're having with their own clients. On the trading side, because volumes have been up, that has benefited specific desks. So equities have been primarily benefited from this volatility, but in fixed income, especially when you look at the debt and equity underwriting, that's going to be impacted in a different way. So those are on the Wall Street, really core banking side of things. And then, but what remains to be seen is the consumer. So in 2 weeks' time, we're going to have some of the biggest consumer banks start to report, and we're always listening for their language around the health of the consumer. Is spending up? Really, for the last couple of months and the last couple of quarters, they have said spending remains strong, the consumer remains strong, but is that going to continue? Is inflation going to come through in any of the numbers? Or are we going to just continue as the strength has been?
Right, a lot to keep tabs on. Catherine Doherty with the latest on the big banks. Sure, we'll see her when they start to report. But let's get to some breaking news that just crossed the terminal. This coming from Microsoft, cutting another 9,000 workers in a second wave of major layoffs. That should affect less than 4% of the company's total workforce, according to the company. But remember, we had an earlier round of layoffs from Microsoft in May that hit about 6,000 people. You take a look at shares, not reacting too much, but certainly a trend developing when it comes to Microsoft.
Yeah, we know that the CEO, Satya Nadella, has said AI is writing 30% of Microsoft's code. Maybe this is one of the results of that. Coming up, Apple's biggest iPhone assembler pulls Chinese factory workers out of India. We'll explain why that matters for Apple's growth in Asia. This is Open Interest. Let's get a look at high interest now. Look at what's making headlines around the world. Paramount reached a $16 million settlement with President Trump over a lawsuit that alleged election interference by CBS News when it showed two different versions of a 60 Minutes interview with then Vice President Kamala Harris. Bottom line, they're going to pay President Trump $16 million, and the market likes that. Health insurer Centene pulled its 2025 guidance thanks to a $1.8 billion shortfall in expected risk-adjusted revenue associated with the Affordable Care Act, Obamacare. The news comes as Congress is poised to slash funding to Medicaid and Obamacare markets, and that's where they get a ton of their revenue. As a result, they lose a third of their value in the pre-market. Foxconn has asked hundreds of Chinese engineers and technicians to return home from its iPhone factories in India. The move is a major blow to Apple's manufacturing push in the South Asian country and may slow down the training of local workforce. You can see those shares are up, but I still want to dig deeper into this news because I think it makes a lot of difference to Apple's strategy, to where Tim Cook wants to make these things. We've got Mandeep Singh, the head of technology analysis for Bloomberg Intelligence, here on set. Mandeep, I saw this story and I thought that's got to be a wrench in Tim Cook's plans, right? Because he was initially moving production from China to India, and now what? The Chinese are making their workers come home?
And India, I mean, to be fair, is already a 20% maker of iPhone units. So the units are being assembled there. But at the same time, President Trump has clearly expressed his unhappiness about assembling a lot of those phones that they ship to the U.S. in India. And look, from that perspective, I do think, they have a much bigger challenge on hand in terms of where they expand outside of these two locations, because they're not going to be able to bring that to the U.S. anytime soon. So, we were talking about how they have to partner with the LLM providers to fix the AI side. That is still fixable quickly. The supply chain side is the harder one, and there is no quick fix. And Foxconn retrenching is probably a sign that, they may have to pay a tariff on a lot of those iPhones that are assembled in China.
Mm-hmm. Well, at least for today, it seems like shares are moving higher because they got an upgrade, actually, from Jefferies. It feels like a while since we've seen one of those for Apple. Jefferies seeing some upside to the third quarter. But, Mandeep, we got some breaking news just before you stepped onto set. This coming from Microsoft that basically they're going to cut 9,000 workers in a second wave of major layoffs. It seems like Microsoft is really looking to reduce headcount here.
And look, I think Coding Assistant as a tool is now pretty well established. It's the fastest growing software category this year. And every software maker has launched, even Google just launched their own Coding Assistant. So what they're saying is, we are not only launching the product, we are actually changing the workflows within our organization. And companies like Microsoft and Google, they have the highest R&D in spend. So a lot of those coders, I think, are going through this restructuring right now in terms of how their jobs are changing.
All right, well, the stock, it's down in today's pre-market, but it's still up 150% over the last 5 years, up 16% this year. Obviously, they're leading by example here.
Yeah, really outperforming year to date. I do think it's interesting to compare and contrast Microsoft, which clearly wants to cut workers, wants to reduce its headcount, to Meta, for example, which is hiring quite aggressively right now.
And spending almost $3 billion in those 10 acqui-hires. We're talking about pretty much a sizable acquisition here in terms of bringing those 10 marquee researchers on board. And look, that's how I think every big player is going to think about, how can I get the smartest people in AI to come and join the team, and probably offset that with some of the legacy kind of products they had and the spend that they were making on those products.
But these are different scales, right?
Yes.
Facebook hiring 10 people.
Yeah.
Microsoft firing 15,000,
Might cost
including
as
both
much
waves.
as the
that's a good point. That's a good point.
9,000.
Microsoft still has 228,000 employees, right?
Yeah.
And Facebook has 75,000. Mandeep, great to have you on set, as usual. Mandeep Singh of Bloomberg Intelligence runs our technology analysis in that vertical. Coming up yesterday, the Momentum Index had its second worst day of the year, and a stock exuberance gauge is near levels seen during bubbles. So we're going to talk about the risk of a burst with Mona Mahajan of Edward Jones. This is Open Interest.
Welcome back to Open Interest. Bubble talk is picking up on Wall Street with stocks hovering at all-time highs. A measure of irrational exuberance calculated by Barclays is reaching levels that have signaled extreme frothiness in the past. It's currently near levels seen in the 90s before the dot-com bubble and the 2021 meme stock craze. Joining us now is Edward Jones, head of investment strategy, Mona Mahajan. And Mona, we're sitting near all-time highs, so things are pretty good. But would you say they're irrationally good right now?
Yeah, look, I think markets went through a period of a near 20% correction. So keep that in mind. So we're recovering from that. In fact, on a year-to-date basis, the S&P is up only 4 to 5%. So I wouldn't say yet we're experiencing any period of irrational exuberance, but we do know when momentum begins, it tends to continue, and markets can overshoot to the upside and can also overshoot to the downside on the reverse side. Now, what we'd say more broadly is, look, we've experienced one pretty severe correction already this year, but in a year with elevated uncertainty, we know 2 to 3 corrections are the norm. So could we expect more volatility in the months ahead, especially as we're digesting more trade and tariff headlines, a tax bill, potentially softer economic growth? Absolutely. We think there is a possibility of that, but we don't yet see any sign of a complete reversal or bear market or bubble burst on the horizon.
How much does time matter? I mean, this time now at the beginning of July, the beginning of the second quarter, we got every institution piling into stocks at the end of the last quarter. So can people wait now and see, like the Fed, for what's going to happen?
Yeah, I think investors and the Fed are in many cases, a wait-and-see mode. Everyone is waiting to see where the tariff rates end up across all our trading partners. And, of course, what the impact is on inflation and the labor market. Thus far, pretty benign impact. And so if that continues, we continue to see the Fed on pace to cut rates. Now, whether that happens very gradually or more aggressively, that remains to be seen. But yes, wait and see does seem to be the mantra.
Okay, hey, Mona, you're going to stick with us through the opening bell. We're looking at futures unchanged. We are moments away from the start of trading on this Wednesday, the second day of the quarter. You can see nothing going on in futures, right? S&P futures are down, but really little change. NASDAQ futures off a little bit more. The small caps are showing some gains. We're really waiting for this big, beautiful bill and then for a wrap up to some of the deals that we hopefully get by July 9th when President Trump says tariffs just go back to Liberation Day levels, or they'll send letters to every country and tell them what they owe. This is, so the Pan Mass Challenge ringing the opening bell at the New York Stock Exchange. Apparently, according to AI, it's the single biggest athletic fundraiser in the country, but I had never heard of it until today. A lot like Centene. State Street ringing the opening bell at the NASDAQ market site, and they have what I believe to be the biggest ETF in the entire world. I've got an expert right here.
One of the oldest, too. We're talking about SPY, State Street. They also just changed their name to State Street Investment Management. They were State Street Global Advisors coming into this week. Let's talk about Tesla shares, because quarterly sales were 385,000. Analysts had been estimating just under 390,000 sales. You can see shares up about 3.5% right now. Some good news for Tesla, Matt. I know that you're going to say that really relative to the valuation, that's not very many EVs, but still shareholders seem to like it.
Yeah. I mean, I say that. Maybe I'll stop saying that.
No, keep saying it.
I say it all the time.
Speak your truth.
Microsoft is cutting 9,000 jobs in a second wave of major layoffs. The widespread cuts in its Xbox gaming division come as Nintendo Switch is apparently the biggest, well, it's not a console, but whatever it is, it's the biggest launch of a gaming device of all time. We're going to talk about something completely different now. We're back with Edward Jones, head of investment strategy, Mona Mahajan. And I wonder, when you look at this big, beautiful bill, Mona, are you able to pull out threads that are useful to your strategy? Do you see something in the legislation that pushes you to invest in, say, real estate and take money out of, say, insurers?
Yeah, I'd say from a high level, and we're still going to parse through the details as they come out, but certainly in the near term, there is some fiscal stimulus that comes out of this bill, whether it's extending the Tax Cuts and Jobs Act, whether it's providing companies a faster deduction on CapEx spending. I think all of that is positive from a corporate perspective. And so near term, we think there is both fiscal stimulus and potentially monetary stimulus, as we talked about from the Fed, coming. That's a positive. Longer term, this clearly is a deficit-inducing, debt-inducing bill, and depending on what estimates you look at, the CBO projecting over $3 trillion over the next 10 years in added debt. That has implications for Treasury yields, especially if there are other competitors that come into the market. Although thus far, we still see the U.S. Treasury market as one of the most deep liquid markets in the world, still able to assume all of that added debt. But that picture could change over time, so we're watching that closely as well.
Well, that's where I want to go. I mean, you mentioned that when it comes to this bill, it could have implications for Treasury yields. But when it comes to conversations about the debt, the deficit, I always ask, is that investable right now? Can you place bets right now based on some of those issues that could eventually crop up in the long term?
Yeah, it's a great call out because, look, over time, rising debt, what it does is crowd out spending from the government in productive areas like R&D and infrastructure, and that could put downward pressure on economic growth. And that does have implications for the market longer term. But what we see, of course, is in the U.S., it's a very innovative, productive economy. In fact, all of the Mag 7 housed here, et cetera. And thus far, economic growth and earnings growth has held up well despite rising levels of debt and deficit. And so if the U.S. economy can continue on that path, this is more of a yellow flag for now than a red flag. And so we continue to watch debt and deficit levels, but we also continue to watch very carefully how economic growth, productivity, and importantly, earnings growth fare out in the years ahead.
If we get, if volatility returns and the VIX, is back down to, I think, 17 or around there, which sectors offer the best relative safety or even upside? Where do you go right now if you want to hedge or diversify?
Yeah, we're still of the mindset that this kind of theme of making sure you're well diversified and broad across sectors is the right approach. We continue to like tech here, and we're equal weight most tech sectors. We're actually slightly overweight consumer discretionary, given we think a lot of the negative news is priced into that sector. We also like sectors like financials and healthcare. To some extent, financials, of course, not as exposed to the tariff noise and can do well in an area or era of deregulation. And certainly if we see extended tax cuts coming, or at least the extension of the TCJA. Similarly, healthcare, we think, can do well if the economy is steady. And by the way, that the valuations there look fairly attractive as well. So broad across cyclical, defensive, and growth sectors, we think makes sense. U.S. large cap and mid cap, we think makes sense. And we still continue to like parts of the investment grade market, especially in that 7 to 10 year space.
I do want to talk about how the different asset classes are talking to each other right now. If you take a look at a year-to-date chart of the 10-year Treasury yield versus the S&P 500, for example, they were talking to each other for a while. But since, just in the past couple of weeks, you can see that break apart. Since about mid-May, you have 10-year Treasury yields heading lower. You have the S&P 500 heading higher. Maybe that's good news for some of those 60-40 portfolios. But Mona, what do you make of that? Is that a sustainable break?
Yeah, I think to some extent, Treasury yields had moved pretty high pretty quickly earlier this year, especially when we got the equity market volatility and there was uncertainty on, the status of U.S. credit broadly, and that drove Treasury yields higher. We're seeing a little bit of a back off from that sentiment. I think that's what's keeping Treasury yields more contained, combined with, of course, a Fed that seems somewhat more inclined to cut rates over time. And so I think that's also helping keep Treasury yields contained as well. We do think Treasury yields are probably more range bound than equities, so probably a 10-year in a 4.5% range makes sense. We could continue to see, testing of the upper end of that limit if the tax bill does have more deficit-inducing qualities. But from an equity perspective, we think markets, as they start to look forward to 2026, they do see both fiscal and monetary stimulus, a potential for the economy to reaccelerate and earnings growth to be double digits next year as well. And so we're starting to get a little bit more enthusiasm around what's coming in the year ahead, looking past maybe some near-term softness as well.
Well, but are we underpricing the risks heading into July 9th? I mean, that's the big I guess, past the jobs number tomorrow. That must be the big day that the market's waiting for.
Yeah, July 9th had been being set up to be a tremendous catalyst for the market, but slowly we've been getting more and more news flow from the administration. Perhaps there will be an extension of the July 9th deadline. Some of the deals will be announced ahead of time. Perhaps we just set the rates, like you had mentioned earlier. And China, of course, is its own beast being negotiated outside of that July 9th deadline. And so perhaps some of the sting or tension of July 9th has been taken out of the market. But nonetheless, we do think that that will be an important date to watch in terms of what the broader trading partners receive in terms of tariff rates. And so while we don't think there may be a high volatility event, it will be an important date in terms of what the future of the economy looks like.
All right, Mona, got to leave it there. Great to get some time with you. That is Mona Mahajan from Edward Jones. Meanwhile, let's get a check on this market right now. We're about 8 minutes into the session, down slightly on the S&P 500. Let's break it down and pull apart what's gaining, what's losing, because you still have 191 names in the green right now. It's what you might want to see. Apple, Nvidia, Tesla, Broadcom, some of your biggest gainers to the upside. More than 300 names in the red, though, so let's go right there. Microsoft, as we mentioned, the breaking news that they plan to cut 9,000 jobs in a second wave of major layoffs. That's dragging down the index. Then you have Berkshire Hathaway and Centene. After that, you have Elevance and United Health. That's because Centene pulled their guidance. There's rising risks from upcoming changes to the Affordable Care Act. That's scary news for the entire group of insurers, and that's what you're going to see on the sector level as well. You have materials up at top, leading gains right now. Energy not too far behind. You go to the bottom, you have financials actually down a little bit on the day. They've been on a record run, might make sense. Then you take a look at healthcare, down 0.6%. Utilities down about 0.7%. Matt Miller.
All right, definitely interesting stuff. We're also focused in on Tesla's global sales. They fell 13% in the second quarter, setting the EV maker up for an annual drop. With regards to sales, shareholders don't care because nothing matters for this company. We'll talk about that with Erin Keating, Cox Automotive Analyst, next. This is Bloomberg Open Interest.
Welcome back to Open Interest. It's time now for our top calls. Some of the analyst action in focus this morning, and we start with Apple getting an upgrade at Jefferies. We haven't seen this in a while. The analyst over there sees upside in the third quarter. That's why you have shares up nearly 2% right now. Next up, we have Goldman Sachs starting coverage of Crocs and Deckers Outdoor with sell ratings. The analyst says that while the market is attractive, competition is getting intense. Goldman has the only negative rating on Crocs, which is down about 1.6%. Finally, we have Ross Stores getting an upgrade to buy over at Jefferies thanks to its wide valuation gap and the margin opportunity. Shares up about 1.6 as well. Matt.
All right, let's turn to autos because Tesla sales came in light at the top of the hour. But the shares are still up 3.25%. Joining us now is Erin Keating, executive analyst at Cox Automotive. And Erin, to be fair, Tesla shares had fallen for 6 days in a row, so a little bit of a bounce back here. But I'm more focused in on the sales, what looks like to me a sales problem. Weren't they supposed to be selling cars at an over 2 million annual run rate? This is like 1.5.
I mean, we know that Elon and Tesla themselves have a pretty big reputation for forecasting things that may not necessarily hit at the right time. But assuredly, Tesla's starting to look like any other automaker. I mean, we're seeing that they're having defection rates that are similar to other automakers. We're seeing that they're having cross-shopping rates. I mean, they've been in the market for quite some time, but they've got a lot of competition, a lot of really good competition in the market now. And so we're seeing the effect of that.
So what does Tesla need to do to boost sales? I mean, beyond the reputational risk, Erin, when you look at the lineup of vehicles, with the exception of the Cybertruck, they're getting a little bit long in the tooth. There's a lot more, as you mentioned, competition, not yet from China in this country, but looks like that may come. Can they just rest on their laurels and say we're the most American car maker out there?
No, and you're right. They're long in the tooth. I mean, what I constantly like to remind people, especially in the U.S., we are a hardware business. People do care what their vehicles look like, how they make them feel, how they drive, et cetera, et cetera. We all know that Tesla has been a great product since it came out. They were certainly first to the board here with an all-electric vehicle. And yes, they have a bit of an advantage with most of their production and product and parts coming from the U.S., so the tariffs won't hit them as hard. But certainly they've been reliant and especially pushing on leasing lately. They've absolutely benefited from the EV credit, which we know may go away. And their product is older and they don't have much. So the problem is they don't have other areas of business that they can really lean into, like the Fords, like the GMs and the big competitors that are coming in now on large SUVs, on trucks, which we know are American favorites. So it's a challenge. I think, one, they do need to update the product. But two, they might find themselves in a pickle given that they don't really have the breadth and depth of car lineup that many of the other traditional automakers have.
Well, at least they have the Cybertruck now, which I see more and more of, Erin. I won't ask you specifically about that.
You like it, right?
I do like the Cybertruck. I like the look of it, but I don't think I would buy an EV. That's a different conversation. Erin, I want to talk a little bit about brand damage. We touched on it, but I remember the doom and gloom cases from a couple months ago about what Elon Musk's involvement with the Trump administration was going to do to their reputation, and that could permanently sort of dent the perception of Tesla in a lot of these retail pockets. Erin, do you think that some of those narratives were overblown, or is that a real serious risk for Tesla going forward?
Here's what I would say, and I came from a long history of doing marketing communications. In the U.S., we are sensitive to brands. We're sensitive to what they mean to us. We're sensitive to what the brands are saying out in the market. We certainly know that Elon Musk has been very central to the reputation of Tesla. And in addition, he really has never leaned on a marketing and public relations team with his brand in the US. And unfortunately, when you don't have those types of things to help you swing the narrative in a different direction, and you're solely relying on an executive to really drive the conversation around your brand, you are putting yourself at risk. Do I think that that's really the biggest problem they have? Again, I think that they're just starting to turn into a normal automaker that has to keep up with product, that has to be mindful of its competitors. And they're going to have to up their game in the market. But yes, certainly we might have seen a little bit of shift here and there in different markets around their brand. But I'm a little hesitant to call it out that that's what's driven most of their sales drop.
One of the tailwinds that Tesla has in this age of big tariffs is that they produce most of the cars they sell in the U.S. Well, most of the components even come from the U.S. They're sort of up there with Ford as one of the most American car makers that there is.
Sure.
Do you see price pressure on the other car makers, Erin? I know we saw a modest gain, and I think the average price in the second quarter was about $49,000, like a 1% increase. But the new cars, the tariff-affected parts and cars are starting to hit lots, right? So are we going to see prices creep up and, the SAR start to continue to drop from 17.6 to 15 and maybe even lower?
Sure. I mean, we're still keeping our baseline projections at 15.7 million. And I mean, here's a couple of things going on. We know that there's pent-up demand still. We have 7 million purchases that didn't happen during COVID. So we know that we still have people who need vehicles. We know there's price sensitivity. The new car market is largely driven by those couple of upper income quintiles, and the affordability issue isn't as high there. And so, yes, while the average price is around $49,000, that is still an average and largely driven by very expensive, six-figure SUVs and large vehicles, pickups, trucks, and things like that, which are very traditionally making up a big part of the new vehicle sales in the United States specifically. Yes, tailwinds are coming for Tesla in the terms of having more American-made product as well as Ford, but Honda's not too far behind, Toyota's not too far behind, and Toyota, Ford, GM, all of these brands have that brand depth again, where they can help to manage their profitability across their portfolio of vehicles. And so, yes, it might advantage Tesla a little bit, but at the end of the day, the segments that they compete in, they're still pretty competitive pricing across the board.
Yeah, it's just interesting to, again, meditate on the valuation and marry that with your comments that Tesla is facing real normal car company issues right now. Erin, hope to speak again soon. That is Erin Keating of Cox Automotive. Now, coming up, Figma sets the stage for one of the year's biggest IPOs. We'll bring you details on the debut that could come this month next. This is Open Interest.
This is Bloomberg Open Interest, a check on stocks. Right now, we don't see a heck of a lot of movement. In fact, the S&P 500 is unchanged, just 22 minutes into this session. The NASDAQ putting up some gains, and if you look at some of the individual stocks that are moving, Tesla is gaining after putting out sales of, I think, 385,000. We were looking for, at the beginning of the year, like 500,000, right? So that's a big miss, really, although, as Ed Ludlow points out, investors may have updated their expectations, like at 859. Apple right now up 2.5%, even though Foxconn is pulling Chinese workers out of India. This is really the big equity story of the day. And Katie makes fun of me because I had not heard of this insurer. They have 28 million clients. They were founded in 1984 in Milwaukee. I've brushed up on it, but they've lost more than a third of their value, Katie.
Yeah.
And Adobe right now down 3 2/3%. It tried to buy Figma for, I think, $20 billion a couple of years ago, and now Figma's going to go public.
Yeah, the one that got away for Adobe, Figma, setting the stage for what could turn out to be one of the year's biggest IPOs. The design software company, it filed yesterday, I believe, to list in the U.S. and could go public this month. For more, let's bring in Bloomberg tech reporter Brody Ford. Brody, great to see you. So give us the details here. What do we know so far about this filing?
What Figma does is it's software to design applications on your phone, on the computer. And it's kind of one of these hit pieces of software that has defined the category, kind of like a Zoom. And the question for them is, can they pivot? Can they expand to be more than just a design software? Can it be used by people across the office and become a kind of a true platform? The growth looks good. The numbers look good. It's all really clean, and investors are pretty excited about this. So I expect their reception to be pretty warm to this one.
I see that they had revenue of $228 million in the quarter through March. So let's say $1 billion in revenue. Are they worth 20 times sales?
Yeah, I think the thing to remember about this kind of software is how sticky it is, right? I mean, if I design applications all day and all my templates are in there and our whole team is using it, we're going to keep paying that, right? I mean, Figma recently raised their prices and, people stuck with it. This is a kind of software that kind of maintains generally.
I have to say, it's interesting to see any IPO filing these days. It's also interesting to see one in July. Typically, it feels like companies maybe wait until after Labor Day to go back to the markets. Not in this case.
I think the trends are very good for them right now, and I think there is this question around AI disruption right now. I mean, Adobe is kind of the classic comparison to them in terms of kind of business, and investors are very worried right now that Adobe can be kind of replaced with these lightweight competitors that are all in on AI, and Figma certainly falls into that category. I mean, they announce in their filing that our margins are going to stay compressed because we're spending so much on implementing AI in our products to make sure we stay competitive.
Even if Adobe gets replaced, you won't be able to get them to stop billing you.
That's true.
It's been the bane of my existence. Tech reporter Brody Ford, thanks so much for joining on this Figma story. Coming up in the next hour, JoAnne Feeney on fears of higher tariff levels on specific countries like Japan. Then we're going to talk real estate with Thor's Sitt, and Hotel 101 CEO talks about her goal of being a top hotel operator in 101 countries by 2040. This is Open Interest. We are 30 minutes into the trading day. Not a lot happening in terms of equities. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak is off, and pretty uninspired trade right now. We did get some ugly ADP numbers this morning, but we know that the big event is tomorrow when it comes to the labor market.
Yeah, absolutely. Waiting for the non-farm payrolls number, which comes a day early this week because of the July 4th holiday. And speaking of July 4th, really focused on one big, beautiful bill.
Absolutely. President Trump's tax bill faces Republican resistance in the House with the vote scheduled for today.
Bank stocks continue to rise as Wall Street's largest lenders unleash big payouts.
And June gloom. As I mentioned, private payrolls unexpectedly fell last month. Attention now turns to tomorrow's big report, which could show further weakness.
The momentum trade just suffered a major setback. A Goldman Sachs index that tracks high momentum winners and shorts losers suffered its worst one-day drop since DeepSeek shocked the markets back in January. Joining us now is JoAnne Feeney, Advisors Capital Management Portfolio Manager and Partner. And we've had, this picture presented to us, JoAnne, today in a number of ways. Irrational exuberance is back, and people are worried about the bubble bursting as well. What do you think of that as we hover at all-time highs?
Yeah, hey, Matt, Katie, good to see you guys. The challenge here is that we have had this strong momentum play for the past couple of months since the Liberation Day pause was put in place. I think it's important, though, not to look at the market as a whole. Obviously, the S&P 500 is trading at pretty expensive levels. But if you break that down into the real solid growth-oriented companies, and they have real opportunity ahead of them and, can support those valuations, look at the rest of the companies, the 490. And those are trading at much more reasonable valuations, and there's still value to be had out there. I think, though, the risks ahead of us are not only the budget bill, which looks like, there's some challenges in the House today, but also a resumption of country-level tariffs, as President Trump threatened yesterday, could really disturb markets. And then you have the geopolitical instability. We have peace for now in the Middle East, perhaps, but the reports suggest that the damage wasn't so severe over in Iran, and will that trigger new strikes from either Israel or the U.S.? So I think it's important for investors to build some resilience into their portfolios in this kind of an environment.
Well, what does resilience look like to you? I mean, is that typical defensive sort of sectors here, or do you have a different definition in this environment?
Yeah, I think there are some specific things one needs to do in this environment, Katie. First of all, given the geopolitical risks, you want to have some defense names in a portfolio. And it depends on your time horizon as an investor, how many years you have to wait out any volatility. But defense names are always a good thing, whether it's a growth portfolio or more of a conservative balance strategy. They can bring you income to help ride out the volatility. But we like names like L3 Harris, and Kratos is in our growth strategy. Other places to look for resilience are some of the consumer staples names, which are going to hold up better if we get an economic slowdown from a resumption of the tariffs that we saw announced back in April.
Obviously, AI has been on everybody's growth playbook, but some of those valuations are looking frothy, speaking of irrational exuberance. Beyond chip makers, do you see industries, companies, we've been talking a lot about software today, that are poised to benefit from the quick adoption of AI?
Yeah, Matt, I don't know how quick it's going to be. I think people might be a little bit too optimistic about the speed of AI adoption. If you look at a recent survey out of the U.S. government, I forget which group it was, but they showed that only about 9% of companies have begun to adopt AI. But that's up from zero not long ago. So it's a big change, but we're going to see a lot more of that. And that's why we are still pretty enthusiastic about the AI play, whether it's chip companies, as you mentioned, or service companies like ServiceNow. But also industrial companies are starting to build AI capabilities, into their products, whether it's a Honeywell or a Caterpillar. And so that could be another place to go to look for some growth that would likely survive a more general economic downturn.
Well, let's talk a little bit about the chip makers, because I'm looking through your notes. I see Avgo on your list, Broadcom. We've been talking about it a lot in the context of perhaps adding it to the Magnificent Seven. It has been on quite a run. Tell us about the bull case there and how it fits into a landscape that's really dominated by NVIDIA still.
Yeah, the firm has been involved in owning Broadcom since I arrived back in 2015. I covered it as a semiconductor analyst since their IPO and knew the company before they went public. This is a company that's extremely well led, number one. And number two, the acquisitions they've done over time have boosted margins, have created positions where they're number one or number two in their product markets. And they now stretch everywhere from software to cybersecurity to networking hardware. And then, of course, the AI play, which is related to their specialized chips that they co-design with companies like Google, and also, of course, in the iPhone. So it's a well-diversified company, very high quality. I believe it's one that should be a core holding in people's portfolios. Again, we've owned it for a long time. And I don't see that valuation as stretched at this point because I think the numbers for their future earnings are still too low. And that creates some upside to where the stock is trading now.
And none of this is dependent on trade deals, right? Because if you talk about NVIDIA, I know that Jensen Huang wants that, what he says is a $50 billion market open. Does Broadcom need that to happen as well?
I think there's still so much demand for adopting and building AI infrastructure around the world that there's a lot of room still for growth. So yes, Jensen would certainly like China to be opened up. I think he makes a good argument for why it's in the U.S. best interest to do that. But there's still a shortage of those chips, whether they're made by NVIDIA or whether they're co-designed by a company like Broadcom. So, it would be nice if we could get into that market as well. But look at all the sovereign investments going on around the world in AI infrastructure. And look also at the enterprise investments. Companies may not want to share their data publicly to an AI model that's in the cloud. They might want to build that capability in-house. So there's still a lot of demand out there for the chip guys. And I see not just Broadcom and NVIDIA, but a company like AMD that's just bringing to market some of their AI-capable chips to customers.
All right, JoAnne, great to get some time with you. That is JoAnne Feeney of Advisors Capital Management. Meanwhile, let's take a look under the hood right now because there's not too much action at the benchmark level, but you see Tesla up about 2% today. Sales fell for a second quarter in a row, but the deliveries were better than feared, I think it's safe to say.
I don't know.
Wow,
I mean,
caught off guard.
Well, no, because I've seen estimates at 400 or 500,000.
It was months ago.
Right. Okay, that's fair. And I think there's a little bit of a dead cat bounce in that as well, right? They were off for 6 days in a row. The fight with President Trump was reignited. Microsoft, you saw there lower after cutting another 9,000 workers, really not moving much at all. But this is the second major wave of layoffs from Microsoft, and we know that they're replacing a lot of their coders with AI.
Yeah, big time. You can see the stock shaking off some of its earlier losses. Let's talk about Apple extending gains right now after getting an upgrade from Jefferies. The analyst sees upside in its third quarter. We know that Apple has a lot of existential questions right now, especially when it comes to AI and the iPhone upgrade cycle, but at least Jefferies sees some light ahead.
Yeah, the supply chain is what Mandeep pointed to as their biggest problem right now and the one that's most difficult to solve. Speaking of solving problems, the New York mayoral race is causing concern for real estate. We'll speak with real estate investing legend Joe Sitt of Thor Equities next. This is Bloomberg Open Interest. Let's get to high interest now and talk about what's making headlines around the world. BlackRock is seeing rising interest from its global clients in diversifying away from the U.S. and into other markets like Asia. Over 20% of the firm's clients said in a recent survey that they were looking at trimming their exposure to U.S. markets as well as to the U.S. dollar. And UK markets tumble as investors grow increasingly nervous about Great Britain's finances and speculation that the Chancellor of the Exchequer, Rachel Reeves, will leave. The sell-off was ignited after Prime Minister Keir Starmer failed to confirm Reeves would be in her post at the next general election when he was asked in Parliament. Reeves appeared to brush tears away during his appearance. You can definitely see that she is crying there. Manhattan home sales in the second quarter were stronger than they've been in almost 2 years, boosted by cash buyers, undeterred by the economic uncertainty created by President Trump's trade war. The luxury segment was a key driver of that strength. Katie?
Well, Matt, let's pivot from residential real estate to what the commercial real estate landscape looks like, specifically in New York City. Zohran Mamdani officially became the Democratic candidate for New York City mayor yesterday. Now, the Democratic Socialist has called for a bold, progressive agenda, including rent freezes and city-owned grocery stores. His win sent shares of New York-focused commercial REITs lower. Joining us now is Sitt. He is Thor Equities chairman and CEO. Thor is a real estate investment firm focused on office and residential urban properties. Joe, it's great to have you with us.
Thank you so much. Appreciate it.
So we have a lot to talk about. We'll start in New York City because you have a big presence there, specifically in Soho. And I'm curious what you make of how the real estate landscape, particularly on the commercial side, might change under Mamdani.
Well, there's great trepidation. Mamdani, my personal opinion is, I don't know that the general population really wanted him necessarily, but I feel like the sun, the moon, and the stars came together for him. You had a rank voting system, people looking for change, looking for answers, sweating affordability and housing, and he happened to be the one, wear a nice tie, have a nice smile, and happened to be the guy the sun, the moon, and stars came together for. But I think at the end of the day, his policies would hurt more his constituents. When you say you don't want to allow new housing or that you want to freeze rents on housing, which will drive developers away from the market and away from developing, it actually causes the rents to go higher. More product, more development, more supply is actually what brings things down. Florida is actually the opposite. Florida is bringing so much free market, so much development, that there you're starting to see rental rates come down, housing prices come down. So his message is really the opposite of what you want. The big question for us all is what happens in Cuomo versus Eric Adams. Eric has the black community, has a strong showing in the Latin community. He's got strong showing in the business community. A lot of young folks following him. And Cuomo, we thought was going to be the guy, but to be candid, that was a serious, serious loss. Yeah. He spent enormous amount of money. As I say, he really didn't do what Mamdani did. Mamdani rolled up his sleeves and got to the people. What Cuomo did was, I joked, I said it was like the Israeli Air Force in Iran. He thought he was going to just carpet bomb New York from 30,000 feet up in the air, as opposed to rolling up his sleeves and getting out to the community. So
we're hearing, for example, SL Green's Mark Holliday is now backing Eric Adams. Are you throwing your hat in that ring as well? I mean,
you know, I'm a political registered independent. I want what's right for New York City.
Well, Eric Adams is running as an independent.
Yeah, I was just going to say that. Yeah. So he finally came along into my party. Right now, I favor very highly Eric Adams over everybody else. I think the city is actually not bad. You know, people say change, change, change. You know what? I don't know that New York City needs change. I think we need more of where we've been heading. I mean, think about it. Think of what you just spoke about. Housing sales going up, more jobs, more excitement. So I think that he's got the solution, but like I said, I like Andrew Cuomo a lot. He's a nice guy. I just don't think this is his race. He's very smart, very intelligent. I really think that Eric Adams has the best shot at going head-to-head with Mamdani if he can get Cuomo to sort of throw his hat in the ring with Eric. And I think the city will be better for it. I think each and every one of them will be better for it. The real question is, if Mamdani does win, does he bend a little bit? Right now, his messages is so hard left because he's figuring, I can't turn off that constituent that won me that rank election. Right. So that's what's scaring people. Not even an ability yet to have a dialogue to know, does he swing back a little bit to the middle? So far, based upon that lack of flexibility, I say Eric is the answer. It's going to be a struggle, but if he learns from Cuomo's carpet bomb campaign and instead go hand-to-hand tactics in the neighborhoods, touch the people, touch the communities, he's got a chance to reverse his weak position currently.
Well, we only have a couple months to wait to find out. Let's talk specifically about the real estate landscape and bring that conversation there, because there have been some larger retail and office purchases in Soho, especially in the past year. And I'd love to hear your sense of where that demand is coming from and whether that's a sign of things to come as well.
A lot of it is coming from other markets that are successful looking for bargains, particularly Middle Eastern investors. Middle East right now is booming. You know, one of the things I joked with you before the segment, I'd given you guys a rare pitch for a story. Normally, I come on when you guys are looking for answers to solutions from yourselves, and I had said Dubai. And at the time, Bloomberg team really didn't see it. Maybe it's a flash in the past. It's real. What's going on in the Middle East, the renaissance, the boom is incredible. That money that's flowing from New York is really as a result of that. Middle East right now, for me, is the most exciting story in the world. First, in terms of the Arab communities, or we'll say the GCC, they want to modernize. You know, for so many years, you have two worlds going in different directions. As I call it, we're in a world of transition. First, you've got the Thucydides trap, I call it, America and China conflict. Then you have the global South versus the Western world. And then what you have in the United States, culturally, you have a country that's moving from, I'll call it, more liberal to more conservative, more Bible sold than probably at any time in the history of the country. And then you have the opposite in the Middle East. You have a culture that maybe had a lot of zealots that all of a sudden the leadership wants to modernize. They realized that if you went back 500 years, the Arabs, the Mohammedans, they were great mathematicians from 500 years ago to 2,000 years ago, bright culture, and maybe they overdid the religion, and now they're being flexible, open-minded, whether it's food, drink, culture, restaurants, gambling, hospitality. They're so much more open. And so they're open to business. And now the final linchpin is really Israel and potential for peace. You know, everybody said over the last few months, you know, it's over, Israel's over, the Middle East is too much risk because of Iran. I say the opposite. Iran made a horrible mistake by launching an attack by each of their proxies one by one, Hamas, Hezbollah, Syria, Iraq, etc. They actually allowed for the Israeli Air Force and Army to actually win that battle, and the United States in finale. And now the result of all that means the existential threat for the entire region, at least for the next few decades, is gone. So whether you're Middle East Arab cultures or whether you're talking Israel, a country with 45% of the population under 24.
But do you want to invest then? I mean, I get the Middle East and Dubai, Abu Dhabi, even Israel. Do you want to invest in Gaza, as President Trump has suggested? Is that even on the horizon, considering the destruction that's been done there?
You know, that one has political ramifications. I think Israel is an amazing Renaissance story in everything. You look at food and culture being exported everywhere. Everybody likes the Middle Eastern restaurant, so to speak. You look at their finance stock prices, their consumer business sales. And as a result of the war now, you see military tech. They're going to be the go-to country for the new way that wars are going to be fought. They're going to be fought with AI, being fought with drones, different types of advancements that only they have the experience for. And of course, they've been sort of, to my mind, leaders in green, because culturally they're more left and wanting to so focus on making the whole world a better place. They're green focused, so to speak. So for example, ourselves, we're an investor. I know one of the things you guys had asked me just before, somebody asked me here, have you invested in Israel lately? What excites you? So there's a company we mentioned before, it's called Electrion. Basically, it electrifies the highways wirelessly, and also even potential for carpet charging. Let's say you have your house, instead of dealing with wires and plugging in, etc. And if the world's moving as we see it is to an autonomous world, and even a robotic world, you're going to need wireless charging, because if there's no driver in the Uber, if there's no driver in the car, how are you going to recharge that car, that battery? So Israel is one country. This company, Electrion, has that solution. So just one example of so many in the country of Israel, in the Middle East region in general, of things that excite me.
Absolutely, and that's a publicly listed company. It's had a rough 2025, but that follows a fantastic 2024. Joe, unfortunately, we're up against the clock and have to leave it there, but it's fantastic to see you. Hope to see you again soon.
I hope and get you back.
Yeah, absolutely. Plenty to talk about. Going around the world with Joe Sitt of Thor Equities. Let's get a quick check on these publicly traded markets in the U.S. right now. You can see the S&P 500 managed to go green just a little bit. The S&P 500 up about 0.3%. Big tech really leading the charge there, with the NASDAQ 100 higher by about 0.75%. or 0.3%. So we'll continue to follow that. But coming up next, we're going to take stock of Centene, stock plunging by the most in 19 years after pulling its guidance. That conversation next. This is Open Interest.
Going to check on sectors and, well, first off, on the S&P with the move screen. This is the most dynamic way to look at the market. You have 220 stocks up, 276 down. So the breadth is to the downside there, although it's pretty evenly split. Apple is actually up because it got an upgrade. You have Nvidia moving up and Tesla too. That helps. Centene is the biggest loser by a long shot in terms of percentage gain losses. Almost 40% of the company's market cap gone after the big, beautiful bill. It pulls its guidance. This is Bloomberg. We have Truth Social post. Donald Trump says that he's reached a trade deal with Vietnam. Details to follow. That has not held back, the lack of detail, Nike and Lululemon shares from jumping to session highs after that post. You can see a 3.5% gain at Nike, Lululemon up almost 2.5%. So clearly, with this deal, you get at least some certainty when we know the details,
right.
Katie. And that's what investors want.
Yeah, and you're seeing that in the S&P 500 right now at session highs, up 0.2%. We will bring you those details as we get them. But let's talk about Hotel 101 right now, going public with ambitious goals. It plans to operate 1 million hotel rooms across 100 companies in what they call a one-room concept. The stock hit the markets yesterday via a SPAC, trading under the ticker HBNB. Here with us now, I'm pleased to say we have Hannah Yulo-Luccini. She is Hotel 101 Global CEO. Hannah, great to have you with us. Just set the scene for us, because reading about Hotel 101, to me, it sort of sounds like a timeshare, but I'm curious how you explain it when you're talking to investors and potential customers.
Hi, it's so nice to be here. So we are the world's first one-room hotel, global hotel brand that is catering specifically to the value segment. We build one type of room across the world, and always on average about 500 rooms, which is 5 times typically larger than your budget hotel, which gives us that incredible operational efficiency that allows us to deliver that kind of value. But what's really interesting about the business model is because it's asset light. We individually title each of the hotel units. So imagine one hotel building with 500 rooms. Those are individually titled, and we sell them to 500 real estate investors. So this allows retail real estate investors with only about $100,000 to $250,000 to invest, be part of a global hotel brand and participate in the hospitality space, while at the same time owning property, which is on a freehold basis. You know, they own that, except we just manage it for them in very long-term management contracts of 25 to 50 years. So when you walk into a Hotel 101, you won't know that it's owned by 500 different individual retail real estate investors, because we manage everything for them. And it's a very hassle-free investment. It's a huge opportunity for retail real estate investors to participate in the global real estate space, as well as ride on to, you know, the rising ADR of hotel room rates across the globe.
So, Hannah, what's your pitch then to potential investors? If I had a decent credit score and was interested in this, how do you sell me? Do you say, I can get you, 10% return, or I can give you financing that's better than, current mortgage rates? What's the pitch in terms of the numbers?
So the pitch really is we would be able to deliver very similar rental yields that you would get if you actively manage your property. So, for example, if you decided to buy a studio across the street from a Hotel 101, you would get similar rental yields, but zero headache. So we manage completely the room. We will not call after you buy a unit. All you need to do is wait every 16th day of the following month. We distribute a portion of the revenue. So we give you a top line distribution. So you have downside protection. You get 30% of gross room revenues of the whole hotel divided equally across all unit owners, because everybody essentially owns exactly the same size room. We're able to do this. And so, if you were to buy a studio, it would be an active management. You'd have to look for a tenant. You'd have to find a broker. You'd have to renovate. If things go, if something leaks, you have to call the plumber. For us, you'd get similar, rental yields, own exactly the same type of real estate because it's a freehold property, but zero headache.
But Hannah, the biggest headache in purchasing a property is the mortgage, right? Do you help me through financing? Do you have somebody set up for that?
Yes, we do offer financing, just like any studios. We work with banks to be able to give financing to our, just like buying a studio. It's exactly the same thing because it's real estate. You hold on to the same condominium title and you can sell it anytime. You're free to sell it.
And I wonder, are you concerned at all that, okay, you have these owners who own individual rooms, individual units. Is there any concern that they might actually buy up an entire property, an entire section, for example? Do you try to guard against that in any way?
Well, we do have, more than one unit owner. So there's a few funds that have started investing, several units or, a larger blocks of investments in a particular property. But all of our management contracts are pretty uniform, where we get to manage them for 25 to 50 years. So we have full autonomy of the property. So it's not a concern for us. In fact, we're looking to open up the market to more institutional investors that are looking for better than the traditional yields.
Hannah, great to get your pitch here. Hannah Yulo-Luccini of Hotel 101 recently went public through a SPAC. Thanks so much for joining us.
All right, let's kind of check on these markets because we did get some breaking news, of course, in the last 10 minutes or so, in the form of a Truth Social post from President Donald Trump saying that we've reached a trade deal with Vietnam. We don't have a lot of details so far, but you can see that the market is reacting. The S&P 500 up about 0.2%. More movement when you take a look under the hood. Take a look at some of the retailers, for example. Nike hitting session highs in reaction to that post. You also have First Solar moving higher as well, not necessarily in reaction there. They're surging after a U.S. excise tax was stripped from the Senate version of the tax bill, which is on its way to the House. And Centene, we've been waiting all show to talk about Centene, down 40% right now. That is the most in 19 years after it's pulled its 2025 guidance yesterday. Let's talk about it with Bloomberg healthcare reporter John Tazi. So, John, Centene, of course, is a dramatic example, but insurers broadly have been growing worried, and investors too, about what changes could be coming to the Affordable Care Act.
Yeah, so Centene is a leading insurer in the Affordable Care Act marketplace, is about 5.6 million members in those marketplaces. And, that is a business that was, supported under the Biden administration. Democrats passed subsidies that made those plans more affordable, bolstered enrollment. Rules that were really sort of favorable for insurers in, selling those plans. And now that's facing a little bit of a reversal under the Trump administration. Those tax credits are set to expire at the end of 2025. Plans will get more expensive for many people. There's also a big push for the Trump administration for what they call program integrity, looking at the enrollment process, making sure that people being enrolled in plans qualify for those plans, qualify for their subsidies, and making sure that improper enrollments are stopped.
So is this indicative of a breakdown of Obamacare? Is this the end of that?
I think it's too soon to tell. There's still a very large and a large market here, but it is a worrisome sign. We saw earlier this year, CVS Health's insurance arm, Aetna, said they were going to withdraw from the ACA market entirely. They're going to stop selling the plans next year. I think what's driving the move among some other insurers, especially looking at some smaller insurers that are more concentrated in these markets, like Oscar and Molina, seen pretty dramatic, I think, double-digit share price drops this morning. is a concern that, the industry has not properly priced for the risk that's coming in these markets, that people are sicker, that the markets are growing more slowly than they anticipated.
It's ironic in a way since, insurance companies are supposed to price risk, but clearly some of these health insurers are struggling with it right now. You mentioned double-digit % losses. That's certainly what you see when you take a look at the S&P 500. Centene down 40%, Molina Healthcare down 20%, Elevance not too far behind, down about 9% right now. John, when you take a look across this industry, across this universe, who is relatively well-positioned here to deal with these upcoming changes?
Yeah, I think it's. I think we'll know more after the industry reports. Second quarter earnings. I think. We've already seen United Health Group, which is normally seen as the industry leader. They pulled their guidance earlier this year. Now that was sort of unrelated issues, not the same dynamic of what's going on with Centene. If you look at a company like Cigna, where their membership is focused more on commercial membership and in pharmacy benefits plans. They may have sort of a different profile in terms of their exposure. But, we'll really have to wait and see how, when we have more information about individual companies' outlook and performance.
John, great to get your take on this massive mover. John Tazi there covers the insurers for us, and Centene has lost now 40% of its value in one session. Coming up next, we're going to get the latest out of Washington as President Trump says he's reached a trade deal with Vietnam. This is Open Interest. President Trump says he's reached a trade deal with Vietnam following weeks of intense diplomacy between the two nations. Retail stocks like Nike are rising on the news because they make so many of their shoes there. Joining us now from Washington is Balance of Power co-host Kayleigh Lines. So, Kayleigh, is this the beginning of a torrent of deal announcements coming out of the administration?
Well, that's what the administration has suggested, Matt. When I spoke with the Commerce Secretary Howard Lutnick last week, he said that they're looking at closing deals with about 10 trading partners by the July 9th deadline that the president has imposed and, of course, said yesterday is not looking to extend. Vietnam, though, would be just the third deal we have seen out of this White House, keeping in mind that there were already deals struck with the UK and then, of course, one formalized last week with China. As for what the details of this particular agreement with Vietnam are, not clear at this time. The president on Truth Social said details will follow. We'll have to wait and see what those details are. But keep in mind that initially, when he announced on what he dubbed as Liberation Day, what the reciprocal tariff rate on Vietnam would be, it was incredibly high, 46%. And the expectation is that whatever agreement will be struck will have a tariff rate set lower than that. That is what was indicated to me by Michael Falkender, the Deputy Treasury Secretary. He said, by and large, his assumption post July 9th is that tariff rates with countries that have made agreements with the U.S. will be lower than what was seen on Liberation Day. Of course, it does indicate that things are going better for some Asian countries than others. Vietnam able to secure this deal, while Japan has been working tirelessly on trade diplomacy as well. The president indicated yesterday that he is not satisfied with what the Japanese are doing, suggesting a 30 to 35% tariff could be imposed on Japanese products, and he intends to just send Japan a letter essentially outlining that.
And we did just get another Truth Social post from the president. He writes that the terms are that Vietnam will pay the United States a 20% tariff on any and all goods sent into the U.S., a 40% tariff on any transshipping, and in return, Vietnam will do something they have never done before. These are the president's words: give the United States of America total access to their markets for trade. So there are just some of the details there. Kayleigh, I know that you are listening in real time, so I'll let you digest that. But you mentioned that Japan, for example, Vietnam seems to be having an easier time than Japan. Is that who we should really be on the lookout for next?
Well, certainly that was indicated by President Trump yesterday when he essentially was putting direct pressure publicly on Japan to make what he would view as a better agreement with the U.S., knowing he is particularly griped in recent days about, for example, purchases of U.S. rice. And again, he threatened a 30 to 35% rate on Japanese goods if something cannot be done by July 9th. It is a question as to what Japan is willing to give in return, as we just saw with this Truth Social post on Vietnam specifically. When he says open their market to the United States, that Vietnam will, he says says we will be able to sell our product into Vietnam at zero tariff, even though Vietnam, of course, is going to be paying a 20% tariff, we understand, based on the president's words on exports to the United States. So it's a question of how reciprocal these countries view these agreements to be, what Japan is going to be willing to acquiesce to that the administration is asking for. But there is still time. The July 9th deadline is a week from today, Katie, and we know the president does tend to try to negotiate in public, to put public pressure on partners to try to get a better deal in his eyes for the United States. But it's Vietnam so far that is the third country to have success, again, to pay a 20% tariff on exports to the U.S. And the president says we will sell our products into Vietnam at zero tariff as we get open access, total access, in his words, to their markets.
Yeah, to me, that's the big takeaway, is that he says Vietnam is going to pay us a 20% tariff. Yeah. So it's not that our goods manufacturers buying things from Vietnam will pay that tariff on import, but the country is somehow going to pay the tariff. In terms of the big, beautiful bill, Kayleigh, and I've been told that that's no longer the official name of the legislation, but do we expect whatever it's called to be passed today or into the night by the House?
Well, that is the question of the hour, Matt. Just quickly on the Vietnam thing, I would say just because the president in his words said we'll pay the U.S. a 20% tariff, that doesn't mean that's actually how it will work in practice when that tax is collected by essentially importers in the United States, just to make that clear. But on this bill, which you're right, is no longer officially called the One Big Beautiful Bill, we're about to get the first test in the House later on this morning or early in the afternoon with the so-called rule vote. This is a procedural measure that essentially dictates how this legislation would come to the floor. And there's a very real chance that the rule itself, which would allow pave the way forward for final passage, could fail. That is the indication from some fiscal conservatives in the House Freedom Caucus, like, for example, Congressman Ralph Norman or the Freedom Caucus chair, Andy Harris, who have suggested they are firm no's on the rule, knowing that there can only be so many Republican votes lost. And there may be some attendance issues today as weather delays and flight cancellations due to thunderstorms here in Washington yesterday have posed a bit of a problem. But it could be up to the lobbying of President Trump as to whether or not this procedural motion is successful. House Freedom Caucus members actually right now are heading to the White House to meet with the president in person, having convened with the speaker earlier today. Trump and Johnson really working together to try to convince these holdouts to let this legislation move forward. But there is no guarantee that path will be easy. The wide expectation here in Washington is that, yes, this bill will pass eventually. It's really just going to be a question of timeline. And if these fiscal conservatives are willing to let this process go as quickly as it could, or if they're going to want to take a bigger stand.
Absolutely. Real split screen programming here. What's going on, of course, with the bill and what's going on with trade. We know that Kayleigh Lines is across all of it. You can catch her on Balance of Power at 1 p.m. and then again at 5 p.m. Eastern. I just want to throw up the intraday chart of Nike as we get details of that trade deal with Vietnam. You can see we rallied and then we lost all of those gains, up about 1% still intraday, but certainly a lot of volatility. Yeah.
Since the president says Vietnam is going to pay the 20% tariff, you would imagine that Nike gets to pay nothing.
It looks like traders a little bit more skeptical, but as Kayleigh Lines said, we need to see how this shakes out in practice. But yeah, it seems like the takeaway from that Truth Social tweet is that there's a 20% tariff on all Vietnamese exports. We'll continue to dig into those details, but coming up tomorrow is going to be a big one.
Yes, July 3rd, we're going to get the jobs report tomorrow. We'll take a look at what to expect from the labor market next. After some disappointing ADP readings today, this is Open Interest. All right, as you probably know, we normally get the non-farm payrolls report, the granddaddy of all economic statistics, on the first Friday of every month. But this week, Friday is the 4th of July, and hopefully no one's going to be here. So we have jobs numbers coming out on Thursday, and we've got Mike McKee here to preview that release for us. Mike, this comes on the heels of some pretty bad data from ADP.
Bad data from ADP that people don't give a lot of credence to, but we also got bad data in the ISM numbers yesterday. So there are some reasons to be concerned. You look back at what numbers we have gotten so far that contribute to what people think may happen tomorrow. The payrolls number is 110,000. The whisper number, only 100,000, as Matt pointed out yesterday. The ADP number comes in negative for the first time in 2 years, negative 33,000 jobs. Jobless claims were 246,000 in the survey week. Now, those were about the same as they were for the previous 3 or 4 weeks there, but they are up from where we were at the beginning of the year. And the ISM manufacturing jobs number came in very low yesterday. So the signs and portents would be for a weaker number. But then what does this number mean in terms of the ADP number today? Well, it was March of 2023, the last time we got a negative number from them, negative 53,000. And 2 days later, the government reported 236,000 jobs were created. However, that has now been revised down to just 85. So if we get a really bad number tomorrow, then maybe it puts the idea of a July rate cut on the market's agenda, but maybe not on the Fed's, because the Fed can only deal with the numbers it has, not with the numbers as they might be revised.
Right. 2 things. Never trade ADP. That is a thing. That's one of the narratives out there. We'll see if that relationship still holds. And to that point, I mean, we heard from Fed Chair Jerome Powell this week, and he basically said it was too soon to know whether or not a July rate cut is a thing that they're going to pursue. But it's already July 2nd. We don't have that many data reports. And as Matt said, this is the granddaddy of labor market reports.
Does that make me the granddaddy of labor market reporters?
Yeah.
Well, one interesting thing about this is ADP gives its data to the Fed, and the Fed can manipulate it the way it wants to put it into its models. So if the Fed were really concerned, we probably would have heard something already over the last couple of months because ADP's had very low projections.
All right, Mike, great to have you here, and we'll have you back with us tomorrow, obviously, as this all-important number comes out. We're going to get reaction to the jobs report as well from the Council of Economic Advisors Chairman. Stephen Miran is going to join us. That's live at 9 a.m. New York time tomorrow, so he'll either be doing a victory lap or explaining, I guess, why it's still Biden's economy. And then we're going to talk to him as well about one big beautiful bill act. I think it's the one big beautiful bill act right now, even though Chuck Schumer apparently tried to
rename it himself. Long and short, there's a lot to talk about tomorrow with Stephen Miran. Really looking forward to that conversation. And those numbers, critically important to this market, even on a holiday shortened week. We'll see what liquidity actually looks like, but we are counting down to that July Fed decision, and there's not too many data prints left.
That's right. And we will also speak with Gabriela Santos of JP Morgan Asset Management. We will have Julia Coronado on the program from macro policy perspectives. And because it's a holiday weekend, Stu Leonard Jr. This is Open Interest.